Good evening and welcome. My name is Charles Goodhart. I'm here largely because in 1986 I helped Mervyn King found the Financial Markets Group. I've remained with that group ever since. And this evening's lecture, my friend Andrea Enria, is entirely suitable for the Financial Markets Group and with it, the Systemic Risk Centre. It might, however, suggest that in some ways, Andrea is trying to put the Systemic Risk Centre out of business, because his role is to prevent systemic risks, indeed in the banking sector primarily, which he's been very successful, I might add. The EU has had virtually no systemic risks during his tenure as the chair of the ECB Supervisory Board. We are particularly privileged to have Andrea with us because he is, in many ways, the foremost practitioner of the art of banking supervision. He has been practicing that almost throughout his working life. And he's just come from, or he's just coming from 5 years as chair of the ECB's Supervisory Board. Before that, from 2011 until 2018, he was chair of the European Banking Authority. But of course, one of the reasons why he's been so successful is that he got an MPhil from Cambridge University. So we like to think of him in some ways as part of our educational establishment. But he returned after his MPhil at Cambridge to the Banca d'Italia, where he worked largely on the supervisory side. Some highlights of that were that he was an advisor to the Prime Minister, Lamberto Dini, for a time. He became Secretary General of the Committee of European Banking Supervision for, I think it was 2 or 3 years, before he returned to the Banca d'Italia to head up their supervisory side of the central bank, from which he went on, as I said, to the European Banking Authority. So there is, I would say, no one in this whole world who knows more about banking supervision than Andrea. He's going to talk this evening about his 5 years in this role as chair and what lies on beyond. But before I pass over the lecture to him, which I look forward to enormously, I've got one or two sort of slightly more formal remarks to make. First one is that the lecture is meant to last about 40 to 45 minutes, but if Andrea wants to go on longer, I'm certainly not going to stop him. Particularly since after he's stopped, I'm going to try and ask him a few questions, and then I'm going to open it up to the audience. I think there are microphones, so when you want to ask a question, and there will be time for questions, wait until the microphone arrives, and then start off with your name and where you come from. Now, besides that, for Twitter users in the audience, the hashtag for today's event is #LSE Enria Lecture. This evening's event is being recorded and will hopefully be made available as a podcast and video, subject to any technical difficulties. We've also got a photographer here to capture the event and a selection of photographs will be made available. If for some reason you don't want your image to be seen, can't think of why, let the photographer know. And then finally, there is no fire drill scheduled for this evening. So if you hear the alarm going off, please leave the building by the marked exits. But I'm going to exit now to my seat and hand over to what we're all waiting to hear, Andrea, your lecture. It's a great pleasure, a privilege to have you.
Well, thank you very much, Charles, and thank you to the Financial Market Group and the Systemic Risk Center for inviting me here today, and thank you for your flattering introduction. I hope you raised the expectations quite high. I hope that I'll manage to match them. I'm very glad for this invitation because, as you mentioned, I will finish my mandate in a few weeks at the end of this year. So this provides me an opportunity to wrap up a little bit these 5 years in Frankfurt at the helm of European supervision. And I think we would all probably agree that the last 5 years have not been particularly easy, but they have not been boring either, I would say. And they've been full of unexpected events that we could well have done without, to be honest. I will start by explaining how we brought the single supervisory mechanism, the SSM, which is the ECB, together with all the national authorities of the countries participating in the banking union, to the next stage of development after a successful startup phase. And the events that shaped the trajectory of the SSM include the exogenous shocks of the last 5 years. So a pandemic, a war at the borders of the European Union, an unexpected flare in inflation with a fast exit from a low-interest environment. But I will also touch upon what I would call the endogenous challenges that we still face, make our supervision more effective in repairing banks' governance, internal models, internal governance and sustainability of business models, and supervising a banking sector that remains to a large extent segmented along national lines, so the lack of integration in the banking sector, and with the, let's say, incomplete banking union that we have, in which political discussions on the institutional frameworks are still hampered by a lack of urgency and red lines set by individual member states. So let me start with the experience in the exiting, let's say, the startup phase of the SSM. Next year it will be the 10th anniversary since the ECB started supervising banks, significant institutions, as we call them, the largest banks, the largest 110 banks in the banking union. And I think we need to go a little bit back to the reasons, for the start of the SSM. If you run back to 2011-12, when the debate got heated, we were in this infamous doom loop between banks and their sovereigns. There was the sovereign debt crisis, and banks were actually at the forefront of the systemic risk that we had at the time within the euro area. And to deepen the understanding of the root causes of the decisions that led to the establishment of the SSM, I would refer to a seminal lecture delivered actually here at the Financial Market Group 25 years ago by Tommaso Padoa-Schioppa, who has been a great source of inspiration for me throughout my career in supervision and European affairs. And the main thrust of the speech of Padoa-Schioppa was that before the creation, before recently, let's say, the European Monetary Union was the first jurisdiction in which the jurisdiction of supervision and the jurisdiction of monetary policy were separated. I mean, there were never in any other jurisdiction this was the case, and it was indeed an unprecedented challenge. And Paolo Schioppa, in his speech here at the LSE Financial Market Group, basically said we could manage to win this challenge if we have the ability of national supervisors to step up to the challenge and in normal times, but especially in times of crisis, to act and collaborate so closely to come out as a sort of single supervisor for the monetary area. Unfortunately, that's not what happened in 2009 and in the run-up to the great financial crisis, especially when the great financial crisis started. To use the words of Jacques de la Rosière, another grandee of the European Union, he said that chacun pour soi policies were the rule of the game. So everybody, every country started addressing the problems of the crisis at the national level. And this meant a huge destruction of value, actually. Meant also large inefficiencies in managing the crisis, because groups that were operating on a European scale were broken down into national components to make them manageable with crisis management tools at the national level. This, of course, brought also to larger impact on national bailout packages to prevent the meltdown of domestic banking sectors. So basically, that was the original scene that eventually led when the twin crises, the great financial crisis and the following sovereign debt crisis led to the decision to amend this loophole and move to European banking supervision. When moving to the banking union, of course, the package was always conceived as a full package: banking supervision, banking resolution, and the deposit guarantee scheme at the European level. Supervision got first, resolution with a bit of delay and some elements still missing, European deposit insurance still not there. And it was clear at the start of the banking union, and still clear when I took my role in 2019, that one of the preconditions to really complete the banking union with all its components was a significant de-risking in the European banking sector. There was this pressure, that in order to pool resources for the safety net, to have a common safety net at the European level, it was important to reduce the level of risk in the sector, to reduce the non-performing loans that we had in the European banking sector, and to bring the banks on a sane footing in terms of capital adequacy, risk management, and especially asset quality. So this issue was indeed still there at the start of my mandate in 2019. And if we take a snapshot of the European banking sector today, we may argue that the mission of repairing banks' balance sheets after the twin crisis, great financial crisis and sovereign debt crisis, the repair of the banks' balance sheets is now fundamentally accomplished. Now, I will not give you, data. If somebody is interested in the published speech, you will find more. But clearly, non-performing loans have been brought back to a level that we don't have long data series because there was no common definition of what a non-performing loan was until a few years ago, basically, until the start of the banking union. But I'm convinced that we have now the probably lowest level ever experienced in the countries participating in the banking union. Capital levels are much stronger than they were, so the sector is much more solid and able to withstand the potential shocks. Liquidity, of course, now with the exit for the extraordinary monetary policy support measures, there has been a little bit of a dip in the liquidity indicators, but they're still largely above the minimum requirements. And if you take profitability, which has been a sore point for the European banking sector, with depressed profitability for a very long period of time, we see that recently also profitability indicators have moved in a much stronger position. If you look at market valuations, they remain depressed. The investors do not yet believe that the increase in profitability is structural, is sustainable, will continue in the coming years. So they are still waiting. But indeed, let's say all the rest is signaling that there has been remarkable progress in repairing banks' balance sheets since the start of the banking union. The second challenge in the startup phase, in moving out, let's say, of the startup phase of the banking union and moving the SSM, the ECB, towards a more mature organization, has to do with supervisory culture. In a nutshell, I would define this as a transition to from a highly codified, procedures-heavy approach towards a more risk-focused, judgment-based and agile supervision. When the ECB was assigned the task of supervision, everything was done incredibly fast. If you take the start of monetary union, the EMI was established after the signing of the Maastricht Treaty, and there were at least 8 years in which preparations were made for the start of EMU, or stage 3 of the European Monetary Union. Basically, the banking union started in a couple of years, and preparations were very rushed. And if I may say, that's at least my view, the task of bringing together 19, then 21 now, legal orders, and for the first time in the history of the European Union, coming in the area of the single market to the attribution of European responsibilities in the administrative side, in terms of administrative powers, was unprecedented. Very complex. We still now have to apply different legislation in different member states in which the banks operate. So this process was done in a very compressed time frame, bringing together, very different authorities with different culture. So it was incredibly difficult, and we did what we do best at the European Union. So we sat around the table and we worked on papers. We worked on codifying the way in which we could do supervision in manuals, in internal procedures. And of course, there was also a great attention to level playing field and fair treatment, let's say, across the board. So not that one bank was favored against the banks of another country. So that led to something which was very structured, very rules-based, very structured. And this hardwired approach, to some extent, strongly focused on capital requirements, and on the need to converge towards common yardsticks, was essential to drive, if I may say with a iron fist, the repair in the balance sheets. And I think it was effective in that respect, very effective. But I recently mandated a group of international supervisory experts to review our own processes. And the main conclusion that they came was indeed to recognize the progress we have made, but also to say that what got you here is not necessarily going to get you there. So that basically what was effective in the first period of the banking union is not necessarily the best that we could have at this stage of the banking union. And when I started my mandate, I was confronted with two main sort of negative feedback on our supervisory approaches and processes. One came from our staff at the ECB and international authorities, and one came from the banks that we supervise, from the industry. Our staff complained that they were basically drowning into very cumbersome type of internal procedures. They say we are there ticking boxes all the time. We don't have enough time to focus on the risks that the banks we supervise are facing. So we don't have enough room for expressing our judgment, for assessing the banks. It's all basically ticking boxes. And they were arguing that we should move to a more risk-focused approach in which attention could be put on the specific risks facing individual banks. And on greater ability to set clear priorities, no, for the supervisory teams. The banking industry called for more transparency, clarity, and predictability from us as a supervisor. They objected that they were thrown at a huge number of recommendations without having clear understanding of what was the real priorities to fix compared to other things, and what they should do actually to improve their scores in the supervisory process, and to improve also, to lighten up a little bit their capital requirements. Over the past few years, we have made quite a lot of progress in changing our supervisory culture. We introduced a system in which the Supervisory Board defines priorities, then the supervisory teams have a sort of risk tolerance framework in which they can decide within these priorities how to allocate their time to what really matters for their bank. And then you have a more a supervisory process that, instead of ticking all the boxes all the years, is now structured in a multi-year process, which relieves some supervisory capacity on the most important things. We also developed what we call a second line of defense, so an internal independent check on what the supervisors do. So instead of achieving consistency through codification of rule-like processes, we have more room for judgment, for discretion for the supervisory teams, but then we have an independent team of supervisors that reviews the work done by their colleagues. And then we also try to send to the banks executive letters that tell them very clearly what are the main priorities on which they should focus, and we have increased substantially the transparency in our work, publishing a number of methodologies, publishing the capital charges that we request each individual bank to respect, and in general providing more visibility and predictability on what we do. But as we were moving into that direction, as in any coming-of-age story to some extent, we were incredibly affected, impacted by the way in which events unfolded, while we were trying to do our journey towards a more mature stage. And this was indeed an extraordinary sequence of exogenous shocks. And it was the reaction to these shocks that, in my view, formed, most importantly, the SSM path towards what we are today. So let me start. The first shock was not something totally unexpected. When I joined 5 years ago, it was something that we knew was coming, and it was Brexit. Brexit was something that was not particularly supported, to use an understatement, by the banking industry. The banking industry was basically trying to dodge the bullet, say, so to maintain everything going as it was the case before Brexit. So doing business from London, basically, and avoid changing too much their structures. But however, let's say, as massive amount of assets and business was being shifted to the European entities, we had to request that also significant amount of risk management capacity and strategic steer was located within the European Union. So there was a so-called policy of no empty shell. You cannot just put in your European shop a sort of letterbox and then have everything managed remotely from London. But while we were moving into the actual implementation of this policy, I was also very alert to the fact that we should not move towards a sort of territorial approach to supervision. So when you supervise global groups, you need to be aware that they have global business, and you need to do good supervision to collaborate closely with your fellow supervisors in the other jurisdictions. So we established very strong contacts with our colleagues in the Bank of England PRA, in the Fed, and we tried to find solutions that were agreed so that also banks were not facing conflicting indications from the different authorities. And eventually that's what we did, and I think that this burnished the reputation of the SSM as an internationally open and collaborative supervisor. The second shock, of course, was the COVID-19 pandemic, and what a shock it was in all respect. This was really unexpected indeed. The real point here was that we were confronted with an unprecedented level of uncertainty. And in front of macroeconomic predictions, forecasts that were giving us possible scenarios in terms of GDP growth, in terms of deterioration of the economy that were really horrifying, we were confronted with a lot of challenges. If we plug, let's say, the adverse scenario that our colleagues in the central banking side of the ECB were considering as plausible scenarios back in the spring of 2020, we were projecting a deterioration of asset quality that would have reversed all the progress made after the great financial crisis and brought us back to that level of non-performing loans. So our concern was also that if the banks were reacting to the shock in terms of increased risk aversion, so dropping lending quite significantly, there could have been a deepening of the macroeconomic shock that would have led to a larger, a deeper, and more prolonged recession. So now, to cut a long story short, I don't want to spend too much time on this, but we try to, to match a sort of very fast, I must say, a few days after the pandemic started, the lockdown started, we started with a package of relief measures that gave to the banks a lot of headroom to use the buffers, use the supervisory buffers, use the capital available to continue lending into the real economy. A lot of operational relief, so suspending a number of supervisory processes, but also at the same time trying to preserve capital in the system, because we didn't know how much the losses could have been. So we asked banks to basically suspend the payment of dividends and the distribution of capital to their shareholders. It's interesting to notice that, this was not taken well by a number of investors, I must say, and we were really criticized a lot. Other authorities globally did basically the same, but basically with moral suasion. So banks themselves took the decisions not to cut dividend payments and buybacks. But moral suasion doesn't seem to work very well in a multi-country jurisdiction as the banking union. So the banks asked us, if you want us to do it, you need to go out with the recommendation and tell us to do it. So it's also an interesting aspect of type of culture that prevails within the European Union. But anyway, let's say if you look at also the empirical analysis which have been developed at the ECB, in national central banks, and in the academia, this set of relief measures and constraints basically managed to support lending during the pandemic and avoid that the banks operated as a sort of shock amplifier instead of a shock absorber. So that was also, I think, a positive experience that we had. Maybe another point which is worthwhile mentioning very shortly is that we also shift our focus from risk levels to risk controls very much. Risk levels were not visible. Usually to measure the deterioration in asset quality, you need to check how the customers are performing in terms of payments, how the borrowers are paying back the loans, no? And if, of course, you have a payments moratoria, as it was the case in most European member states, you cannot see. I mean, no customers are paying back, no, because the payments are suspended. So you need, the thing we did was to focus very much on the internal controls of banks. And that remained a very strong point also after the pandemic and still now. And I think will remain a very important learning from this experience. The other point is that the pandemic, and that was also the case with the Russian invasion of Ukraine, led us to develop much more sectoral analysis. It's clear the pandemic was hitting very hard, I don't know, the transport, aviation sector, the hospitality sector. So we started really digging much deeper into the individual sectors hit by the crisis. And the same happened afterwards with the invasion of Ukraine, where it was maybe energy sectors, commodity trading, and also clearing in energy products that were particularly margin calls or in energy derivatives, for instance, that were the origin of the problem. The invasion of Russia, let's say, of Russia in Ukraine, created also a shift, no? Because basically it was not really an issue of direct exposure, because the direct exposure to Russian counterparts, Ukrainian counterparts by European banks were very contained. There, the issue was the energy shock, the impact that could go through the European economy, the impact on some sectors, manufacturing, shipping, as I mentioned before. Cyber risk also started growing quite fast in our agenda, because the possibility of state-sponsored attacks became much higher in the new geopolitical environment. We also put a lot of pressure there to try to push banks, our banks, European banks, to significantly downsize or possibly exit Russia, not only because of the heightened risk, of course, in Russia, but also because they lost the ability to control what was done by their Russian establishments. So, and if you don't have an ability to control your own shops, of course, you can very well trip into a transaction with a sanctioned counterpart, or major reputational issues, because, for instance, you are indirectly financing the war effort. So I think that was, this is a process which is still ongoing, but we put a lot of pressure there. The third shock was inflation, of course, the spike in inflation that was, of course, driven by the rapid exit from the pandemic, coupled with the energy shock and the increase in commodity and food prices that accompanied the invasion of Ukraine. And as a final cherry on the cake, of course, this sequence of shocks started destabilizing banks in some countries, regional banks in the US in the last spring, and then Credit Suisse also entering into a rapid crisis at the same time. What was interesting in that period for me, from my observation point, as Charles already said, the European banks were not really very much affected by this time of turbulence for a number of reasons, possibly also the repair in the balance sheets that was achieved, the recovered profitability, and maybe also, I like to think, the stronger supervisory pressure that we exercise on them. But besides that, I think that what really scared me to some extent was that in such an environment, we saw that when there is a moment of market turmoil, investors really start looking at banks on a mark-to-market basis. And they start looking so if banks have, banks traditionally are, lending long and they have short-term or side liabilities. So naturally, when there is a shift in interest rates, they don't fare very well in terms of a mark-to-market economic value of equity, let's say, metrics. No? So But also there was a lot of attention on what was the next weak link. There was a hunt for the next weak link, focus also on weak business models, weak governance, like the case of Credit Suisse and regional banks in the US. And this really occurred through an immediate challenge in CDS markets and equity markets where investors were taking short positions, triggering then reactions from uninsured depositors, corporate treasurers, institutional depositors, basically pulling out deposits very fast. This type of dynamics can be very destructive for banks, which means that from the supervisory perspective, we started focusing much more than in the past, and we need to do this even more now on diversification of funding sources, strength of funding sources, resilience to shock on the liabilities side. So these are all very important points, and I'll come back to that. Also, the issue is, of course, making sure that you have good governance, good sustainability of business models, and effective supervision, points on which I will come back shortly. Now, moving towards the end, endogenous challenges. The first endogenous challenge, in my view, goes under the label of effective supervision, how to achieve effective supervision. What do I mean by that? The point is, when you go on your supervisory tasks, on-site or also off-site surveillance, you identify weaknesses at the banks, and you recommend that these weaknesses are remediated. Sometimes these happen fast, sometimes less fast, and for instance, in the reports that the Fed and the Federal Deposit Insurance Corporation, the FDIC, made after the failure of Silicon Valley Bank and Signature Bank, it was clear, they were very candid reports, they admitted very clearly that they were not fast enough. They identified the problems, and they were not fast enough in moving to enforcement actions and remediating the shortcomings that they had identified. And here, I would say, is a challenge for us. I mean, for us all. Not only, it's not something that is specific of the Fed. It's a sort of global issue that we are facing. After the great financial crisis, there were a couple of papers, reports. I mean, Jose Viñas here from the IMF. There was a very nice paper of the IMF on learning to say no. There was a very good report from a group chaired by Julie Dixon at OSFI, the Canadian supervisor, trying to put the emphasis on the strength of supervision. But then the financial reform dialogue and debate focused very much on calibration of capital requirements, liquidity requirements, leverage ratios. There is where the industry also put a lot of lobbying efforts, and we basically did not put, in my view, enough attention in the global debate on the effectiveness of supervision. Now, you would say probably, so what? I mean, of course, supervision needs to be effective. I mean, what a big discovery. Effective supervision is better than an ineffective one. But, let's try to go a bit deeper. I think we in Europe have been effective in the areas where we could easily confront the bank with clear quantitative targets. We want to reduce NPLs, non-performing loans. We gave targets to the banks, and we hammered them down until these targets were achieved. We wanted higher capital ratios. We put requirements. If a bank were not complying, there were enforcement actions and definitely follow-up actions from the supervisor. When you go into issues such as governance, such as internal controls, such as business model sustainability, of course it's much more difficult for a supervisor to be effective, because these are the areas where the basic levers are in the hands of the boards and the management of the bank. It's difficult for us as a supervisor to step in and say, you don't have the right business mix. You should invest more in this area and less in that area. Your board is not effective enough. We can say that, but it's not easy to say how to remediate to these weaknesses in board dynamics. So this is is the challenge that if you take a bank like Credit Suisse, for instance, if you look at the capital ratios they had, or the liquidity ratios even until few days after the crisis, they were well above the minimum requirements. But still, the bank had very poor internal controls. They were identified by the bank itself, by their own internal reports. And the auditors, a few days before the crisis, said that the valuations could not be trusted because of the poor internal controls. So if this doesn't work, eventually, where turmoil starts, the bank can go underwater very fast. And then we need to be more effective in dealing with these issues. And I know that the issue of supervisory effectiveness maybe is not particularly sexy for an academic audience, because again, it's much easier, or more maybe interesting even from an academic perspective to focus on incentives, and constraints set out in regulations. It's not a surprise that after the spring crisis, most of the papers I read were arguing for, tightening the regulatory standards, or maybe even adopting more radical solutions, to, for instance, move to narrow banking or eradicate instability from banking by putting some strong structural constraints. In my view, there is no philosopher's stones like remedy to instability in banking, at least until you will have banks doing liquidity and risk transformation as they are doing today. So we need to really understand how to strengthen the effectiveness of supervision, and some academic help in this area would be very, very appreciated. The second endogenous challenge that we faced, I would call it the challenge of integration. And this is very peculiar for the euro area banking sector. As I mentioned before, let's say the very origin of the banking union was to respond to a problem that was linked to the intimate connection between sovereign and banking risks during the aftermath of the great financial crisis. And to understand what the real point is, in my view, the key issue is that only when a banking sector is enabled to, move capital, liquidity, financial resources seamlessly in the market in which it operates, you could have what economists refer to as private risk sharing. So that basically a bank is able to compensate losses if there is an idiosyncratic shock hitting a country or a region of the banking union, of the monetary union. Banks having business throughout the area can compensate the losses in those regions with profits in other regions, and therefore continue lending into the economy. Another important element of integration is that when you do have a crisis, nonetheless, if you are in an integrated market, the resolution authorities like the FDIC in the US can very well sell banks, whole businesses, or lines of businesses to other banks coming from other states. That happened in the crisis in Nevada, in Puerto Rico, but not on the same scale, I would say, within the banking union. All the resolutions were basically managed at the national level. So that's another element of constraint to the authorities. So what we are missing still is an integrated safety net, is an integrated deposit guarantee scheme, the European Deposit Insurance Scheme. The proposal from the Commission is on the table since, if I remember well, 2016, and still not making any progress. And political agreement is not really forthcoming. Why is it the case? If you take the perspective of finance ministers, the way in which they look at this debate is we'll approach at the end of the year almost 8 trillion of euros of insured deposits in the banking union. And the perception from a finance minister is, oh my God, I'm asked to sign a joint and several guarantee on 8 trillions of euros. That's of course not the issue. I mean, in every system in which the crisis management mechanisms work, actually you never cover the full, reimburse all the depositors, basically. You do have the deposit guarantee scheme, the FDIC, for instance, in the US, intervening on a least cost basis and, acquiring the failing banks, selling assets and liabilities, and eventually minimizing the impact on the fund, and eventually it's the banks themselves that replenish the deposit guarantee scheme. So in most cases, there is no need for a taxpayer's money. But still, let's say, in the absence of a common deposit scheme, there are constraints that are put in legislation and by national authorities to the seamless operations across the banking union. So at the moment, for instance, if you have a subsidiary in a single member state, the capital and liquidity requirements on these subsidiaries can be waived because you are controlling the parent company. But if the subsidiary is in another member state of the banking union, notwithstanding the supervisor is a single one, is the ECB, still you cannot really benefit of the same waivers. There are limited amounts which are enabled and which have never been used. Now, the lack of a truly integrated safety net leads also to member state ring-fencing business within national boundaries, and it's a sort of vicious circle, no? Because they ring-fence within national boundaries. This segmentation means that you have less private risk sharing, so the likelihood that the DGS, the national DGS, is eventually activated and even depleted is higher, which of course reduces the willingness of finance ministers to pool resources and support the European Deposit Guarantee Scheme. So basically, an incomplete banking union is the reason why cross-border banking doesn't develop, and the fact that cross-border banking doesn't develop is a reason why the political willingness to complete the banking union is not there. And I'm not here to look for excuses. When I started my mandate, this was one of my top priorities, trying to increase the integration of the banking sector in the banking union. And I must say that in these 5 years, there has not been progress. I have to be honest on that. There has been actually, if anything, a sort of regress in this area. And the markets are now more segmented along national lines than was the case in 2019. I don't think I can regret a lot in terms of what I did. We put a lot of proposals on the table to support integration. We said clearly that we will treat cross-border mergers on a same footing as domestic one within the banking union. We have offered to use the limited spaces that are there in legislation to use cross-border waivers for liquidity requirements. We also looked with great interest to what the Brexit banks relocating to the banking union have done. They have actually adopted the European Company Statute, so a corporate legal structure that enables them to merge with the cross-border mergers directive all the subsidiaries into the parent company, so they're now branching out throughout the single market. So the paradox now is that the Brexit banks are the ones that are exploiting the single market at its best. And we suggested that other European banks could do the same and branch out, having then no limits to capital and liquidity requirements in every individual member state. But this, we also try to foster proposals under the current or with adjustment to the current legislative framework on crisis management to address the concerns also of individual member states. And these proposals have been brought forward by the Commission with the suggestions on deposit guarantee schemes, which are now under discussion. But these attempts to foster banking integration within the current legal environment or with minor adjustments have not been successful so far. We created options, but the industry decided not to take advantage of them. There could be good economic reasons for that. Of course, if banks are not very profitable, if their valuations are very depressed, they might see more advantages to return capital to shareholders with a view of increasing valuations, no, and bringing them closer to book value, rather than expanding their business through mergers in other member states. And when they did pursue consolidation strategies, they were trying to maybe pursue more a cost efficiency objective of reducing costs in areas where they have overlapping branches, so domestically, rather than diversifying revenues through cross-border mergers. But in some cases, banks also stopped pursuing these projects as a result of concerns raised by national authorities. And if the industry doesn't take full ownership of the goal of achieving market integration and does not fight for it, of course, it will be very difficult to make real progress. And maybe the lack of support by individual member states came also because of our success on the supervisory side. So there was the impression, okay, supervision works, the system is stronger, why should you take very risky and difficult political decisions while there is no reason for that? There is this British saying, no, if it ain't broke, don't fix it. But maybe this was said also before the great financial crisis. When you realize it is broken, then it is very costly to fix it. So let me conclude. I'm of course being very honored, and it has been a great privilege to lead European Banking Supervision in the last years. There are a number of achievements that I try to cover today with you. And I think we can be proud of a lot of the things we did in the last years. There are also areas where we have not achieved enough progress in market integration, as I mentioned, is one of those. And I really hope that these vicious circles that now prevent dealing with completing the banking union will be addressed, and progress can be made in the next legislature starting next year. But even with these difficulties, I think we should not be disheartened. And besides the progress in terms of strength of the European banking sector, that has acted more as a shock absorber instead of a shock amplifier in the shocks that I mentioned today, I think that we have also made considerable progress and efforts to make the SSM as the mechanism of collaboration between the ECB and national authorities much more integrated, making our supervision more risk-focused, more agile, and better equipped to tackle the supervisory priorities. I was surprised myself of the velocity with which this tanker moved in response to the shocks that we were confronted with. And we are a complex organization. Our supervisory board has 27 voting members appointed by national authorities. If we were to see these type of arrangements in a commercial bank, I think we would not be particularly pleased. We have rather cumbersome procedures, complex legal framework, including various rules, as I mentioned before, in different member states. But this complexity makes for lively internal debates, protects against groupthink, and strengthens our internal checks and balances. As I mentioned, we have been surprisingly agile in face of shocks. We have rapidly adjusted our communication with a single voice across all the authorities, which was not to be given for granted, I can tell you. And this is the beauty, I think, of European institutions. Looking at their organizational structure and decision-making processes, you might think that they could never work, not in good times, and especially not during a crisis, but they do. Not least thanks to the commitment and passion of their staff and the clear benefits brought by mixing different cultures and learning from each other. So paraphrasing Ludwig Wittgenstein, we could say that the most remarkable aspect of European Economic and Monetary Union and the European Banking Union is not how they are, but that they are, that they simply exist. Thank you very much.
Perhaps the only real advantage of being a chairman is you get to ask the first two questions. So my first question to you is, the efficacy of financial supervision depends in some large part on the human skills of the supervisors. And for example, the SVB failure was, I think, a financial supervisory failure in some large part. Now, how do you get and maintain the best possible supervisors? How do you get your team together? How do you ensure that they're as good as can be? Or put it another way, who supervises the supervisors?
Well, let me say, first of all, if you look at the job profile of a supervisor, it shouldn't be a very attractive job, is it? I mean, when things go well, nobody thanks you. When there is something going wrong, everybody grills you, no? So, but still, let's say, so nobody in his right mind should actually pursue a career in supervision, but those who do actually are very passionate about it. I mean, they really enjoy the job, and that's also for me a commercial for those in the audience that want to pursue a career in supervision. In general, it's something that is very rewarding in terms of serving a public interest in a very important field. Of course, at the beginning, we were able to attract a lot of expertise from the national authorities who had an interest in affecting the framing of the new supervision at the European level. But then you had to maintain this. There is a lot of training that we are doing, training programs that we are doing. This is very, very important. We are investing a lot in what we call SupTech, so use of new technologies for the purposes of supervision. And we try, of course, also to have a good way or a good circulation of staff across areas, across authorities, and also with the central banking side in the Euro system. So I think these are all important elements. Who supervises the supervisor? I mean, we have plenty of accountability structures with the political, let's say, side. In 10 days, I will be in Brussels for hearings at the Parliament with the Eurogroup. But besides that, I would say that the internal mechanisms are very, very strong. Also, we have, our second line of defense. So we have the supervisory teams. Then we have the so-called first line of defense, which is horizontal analysis done across banks. Then we have a second line of defense checking the outcomes of our processes. We have independent on-site supervisors, which is an important element, which doesn't exist in many supervisory authorities. And we have internal audit. Then we have the European Court of Auditors. And I'm also proud that I asked independent supervisors to review what we do and to advise us on how to improve it. So I think we have a pretty robust framework right now.
You mentioned technological advances. Now, one of the things that supervisors must have to do is plow through masses and masses and masses of data. Do you think that the advance of AI, artificial intelligence, will actually improve the life of supervisors and make supervision possibly easier and better, or not?
Yes, we are, as I mentioned before, we're investing a lot on technologies for supervision. We have already started applying AI in supervision. The first block was very much focused on efficiency. So on basically making the life of our supervisors easier. So for instance, we use natural language programming to process very thick applications from banks, summarizing them, identifying the issues which are most important that we look for, and therefore enabling supervisors to focus on what really matters and not spending time browsing through very thick applications. The second stage is, as you mentioned also, the integration of databases. We have a huge amount of information, but this is not well integrated. We are actually putting a lot of pressure on banks to have better risk data aggregation capabilities within their organizations. We are now trying to create what we call a data lake, bringing together information from the central banking sources, supervisory sources, market sources in a single place for all the supervisors at the ECB and in the national authorities. And this should be ready in a short while. And the third, of course, challenge will be to deploy artificial intelligence for analytics. There, of course, we need to be careful not to, not to get too much hostage of, models that we don't control. No? I think that supervision need to maintain a good level of judgment from the supervisors, and we should avoid transforming it into a sort of, data check type of exercise.
Right, well, we now open to questions. In the back, waving his hand. And I know who you are, but tell the audience who you are, John.
I'm John Danielson at the London School of Economics.
It's not on. What? I don't think the mic is on. Okay.
Andrea, John Danielson at the London School of Economics. Thank you so much for coming here. The talk was absolutely excellent, and I think the citizens of Europe have been quite fortunate having had you at the helm over these past 5 years. Since we are in a university, I hope you forgive me for asking two related academic questions. Now, the European supervisors and the ECB, they are working for the citizens of Europe. And what is your objective of the European citizen for employing you? And the second question is, since we are also hosted by the finance department in LSE, the basic principle of finance is if you want more performance, you need more risk. And in Europe, we are suffering from lack of economic growth. So do you think the European banking system needs more risk or less risk?
Well, on the first question, I don't know. Everybody, remains attached to the textbooks that they use when they were at university. So I was very much influenced by the book by Matthias de Waterpont and Jean Tirole, on the prudential supervision of banks, which basically interpret the role of supervisors as delegated monitors of on behalf of depositors and deposit guarantee schemes, of course. So basically, for me, the description of our core task is exactly to, monitor the managers on behalf of a wide set of dispersed depositors that would not be able to assess the risk of the banks that manage their own savings. So. I think that, and unfortunately, sometimes our own, the people we protect, of course, are not in the first line to defend us when we are under criticism. But I think that there is a good, and that's what is a little bit what I was mentioning before as the conundrum of supervision, that there is not a lot of upside in the job you do. But still, I think that there is huge value added in. We have seen how devastating banking crisis could be for social welfare and for our communities. So I think that restraining to some extent containing the likelihood of this crisis to materialize is quite an important task that we have, and against which we should be, of course, assessed. The second question, oh my God, I forgot it. Well, again, the point, I think that the challenge for the European financial sector is to have a better balance between the traditional risk transformation that banks perform well and the riskier, the ability of processing longer-term risk that is more in the remit of capital markets. The real issue is that we have a sector that is still very much focused on bank lending, also maybe for type of projects that would be better financed by equity, and we don't have a very well-developed capital market. There has been a twin project of the Capital Market Union, which in my view has been mistakenly focused on regulatory harmonization more than creating structures and opportunities and maybe also other aspects such as taxation or to some extent that project has not yet been effective in delivering, but eventually if you want to finance more growth and more risk-taking, I think we should not ask the banks to take higher leverage and higher risk and then eventually create the premises for the next financial crisis, but rather develop more capital markets, I think.
Question in front here, please.
Kevin James from the Systemic Risk Center. There's been increasing pressure to use banking supervision as a way to implement social policies. For example, green financing or diversity goals in the financial sector, or other elements which are not core to the traditional, at least the traditional function of protecting against systemic risk. Do you think those are legitimate purposes for banking supervision, and do you think they can be well implemented, well integrated at the same time as the more traditional functions?
Thanks for the question. I think that as supervisor, we should care about diversity. We should care about climate and environmental risks, but we should stay firmly in our prudential remit. So we shouldn't do it with assignment of tasks to pursue other objectives than our specific prudential tasks on risk-taking. Diversity for me, we see it in practice. If you have boards which are more diverse, not only gender diversity, but also in terms of skills. We have seen, for instance, some time ago, we made a survey, and it was actually a self-assessment by the banks themselves on the effectiveness of their boards in preventing cyber risk. And it was clear that, surprise, surprise, if you have some cyber IT expertise in the board, banks are less subject to cyber attacks because you have a greater steer from the top to the management and to the staff in terms of dealing with these issues. The same in terms of climate and environmental risks. That's a real risk. We do have already now these risks materializing in terms of physical risks, so with wildfires, floods, and in terms of transition risks. Banks are engaging into very long-term lending on building malls, commercial real estate projects, and they have no ability to assess the environmental footprint of the collateral that they are taking. And it might be that this collateral in 5 or 10 years from now will be worthless because it doesn't have the right environmental footprint. So I think that this type of factoring climate risk in the process, having also some experience on these type of risks in the board could be very effective, but strictly on a prudential perspective, not let's say as an actor of other policies. So that's my view.
In the sweater, holding the hand up there. There we are. Good, thank you.
Hi, thanks for the talk. I'm Michele, a second-year econ student here. I had a question regarding at the end we were talking about the integrated safety net, no? And European banks have historically traded on this compressed multiple to their American peers, no? Consistently trading at below 1 price to book. Do you think if they continue down this path of increasing segmentation in terms of how they approach the safety net, not integrating and continue down this kind of segmented approach, can they achieve a level of stability that allows allows them to reach a level of stability that's good enough for the market to price one to book? Or do you think really the integrated safety net is necessary in order to achieve kind of this aggregation to the multiple seen in America?
Well, that's a difficult question. Thank you for that. I mean, for me, completing the banking union is of paramount importance. It's something that, again, strikes me as something that has a very low, real cost, a high perceived political cost, but a low real cost, and would bring about major benefits. But I think that also, irrespective of that, within the current legal order, we could go much further than we currently are. So, and that could already help the banking sector achieve better results. It's not only an issue of banks making higher profits and having better price to book ratios. It's also a point of the benefit for the final users of banking services, depositors, borrowers. I mean, I travel every year through all the capitals of the banking union, meeting banks, meeting the supervisors, our supervisory teams. I mean, you do have countries in which banks already now, if you go in the Baltic countries, for instance, they are already projecting return on equities for this year north of 30%. And the markets are very concentrated. So my point is, why isn't there somebody else from the rest of the banking union opening shop there, opening branches there, and basically trying to increase competition in these markets? And this would bring, of course, value added for the borrowers, but also depositors. And we are all discussing pass-through of higher interest rates to depositors that is proceeding slowly, And we see a number of governments that are proposing now taxes or levies in that area. But actually what is not working properly is competition. So having, even within, for instance, using more branches, as I was mentioning before, would, in my view, bring us already a long way towards that objective.
I think there's a question on the edge there. Thank you.
Thank you. Ciao Andrea.
Name and
Brunello Rosa, Rosa and Rubini Associates, and various academic affiliations. A couple of questions. You mentioned that, of course, the banking union is not completed, EDIS is not there, and there are other elements missing, and the capital markets union is not finished. How this has made your job more difficult? So why is it more difficult to do your job in the absence of the banking union? Second is the fact that the ESM has not been fully ratified with the backstop that it provides in case of a banking crisis. Is it also making your job more complicated, and why? Thank you.
Well, I need to see how I can respond, give a short response to this question, Brunello. When I have a bank that starts approaching the wall, that is close to crashing against the wall, my job becomes very difficult because I have different arrangements in each member state. So there are countries where, for instance, take ABLV in Latvia. It defaulted. It went into a crisis a few years ago, just because of AML issues. So it was put on a list. There was a press release by OFAC in the US, highlighting the money laundering issues that at this bank. The bank lost access to correspondent banking, so it was basically dead in terms of access to funding in a few hours, not even days. So we called the bank failure like to fail. The bank was brought under the local legislation. There was no administrative liquidation in Latvia. So they brought this to a court, and the court said, but actually there is no insolvency here. So they didn't open to liquidation. So basically we couldn't liquidate the assets of the bank and reimburse the depositors, we couldn't even take away the license of the bank to some extent. It was very difficult because it was not declared insolvent by the court. Case of Sberbank, after the invasion of Russia. Again, different operation of the deposit guarantee schemes and the legal framework for liquidation in Austria, in Slovenia, where Sberbank had an important subsidiary, the fourth bank in the country, and Croatia, where they had the third bank in the country. So also there, we had to operate with different legislation, and we had to scramble to find a solution in 2 days, because we had a moratorium for 2 days. So if you take the FDIC, they purchase the failing bank, they manage the purchase bank, and depositors are very safe because they know that it's the authority that is managing the bank. Their deposits are safe, so they don't run. And eventually, a least cost solution is found within a reasonable time frame, usually a few weeks. We have 2 days of payments moratoria, and we need to find the buyers in 2 days. Otherwise, we need to go through very different national arrangements. I mean, that doesn't make my life easy, because if I call a bank failure like to fail, I want to know what is the solution to this crisis, that it doesn't disrupt the local markets, that doesn't create systemic implications. So having the approval of the package, of the legislative package, which is now at the attention of Parliament and Council, would already bring us a long way towards fixing these issues. Of course, completing the banking union would bring us the whole way to fixing these issues, but let's say the first step would already be a great progress.
Question over there, right at the far side, right.
My name is Hideki Sato from Kansai University, Japan. So currently, I'm an associate staff of the FMGs of LSE. So thank you very much for the very insightful discourse tonight. So I have 2 questions, and the first one is interplaying between the EBA and the Supervisory Board of SSM. Of course, you are the head of them. I've visited the EBA twice under your beforehand of the COVID. So this is, of course, the EBA is totally different from the stemming from the SSM. So they're enacting from the 2007 report in 2009, and after the 3 years later, the SSM is started. So my first question is, what's the strengths of the overlapping or intertwine between the EBA's policy and SSM's policy? This is my first question. The next question is completing of the European Banking Union. Of course, is various kind of the questions already mentioned, but the German opposition since 2016 by the Bundesbank monthly report is a strong opponent of the completion of the European Banking Union, especially for the harmonization and convergence of deposit guarantee schemes. But another aspect was to plan B, to cooperate with the Basel Committee, or another is FSB as well. Only the 2/3 of the pillars has implemented actually, but the one pillar is very crux of matter. So to retour about the international harmonization to strengthen the deposit guarantee scheme in France, for example, the cooperation between the FDIC in US and the digital banking is a content changes is very striking region last spring. So to hand with the United States or international committee is a plan B to strengthen the banking union in completion. What do you think about it? Thank you very much.
Thank you. On the relationship between the EBA and the SSM, again, as usual in Europe, we have to make it a little bit more complex. Usually, in most jurisdictions, you have the administrative rule-making power and the supervisory powers, which are located at the same authority. The FDIC issues rules, guidance for the banks. For instance, or here in the UK, the Bank of England. I mean the Fed and the Bank of England, the Fed, FDIC, and OCC. To be honest, in the US, to make it a bit more complicated there as well. And the Bank of England here implement directly the Basel packages in the US and the UK. We actually don't have this power. It is with the Council and Parliament, and then it is the EBA which has the rulemaking aspects. We only have at the ECB now the day-to-day supervision of banks. We can issue, of course, some guidance, some supervisory guidance, but basically we have no rulemaking, no direct or very limited, let's say, speak under control, Giovanni, that rulemaking powers in our field. So this means that we need, and the EBA is a remit which is EU-wide, so 27 member states, covering also the out countries, so the Nordic countries, Sweden, Denmark, Poland, and therefore, let's say, has a different geographic remit to say. So this means that we need to coordinate much closer with the EBA to ensure that the natural loop between rulemaking and actual implementation and application of the rules on the field works well, which is something that I paid a lot of attention to. And the cooperation and collaboration with EBA is very strong. In terms of EDIS, first of all, it's not only German opposition. To be honest, there are many member states, each of them having their own red lines and conditions that, of course, cross the red lines and conditions of other member states. So it's a complex process. Can we rely on international bodies? I don't think more than is already available. And basically, after the crisis, already there has been a lot of effort done under the aegis of the Financial Stability Board, not to have what are called the key attributes for effective crisis management. And these are the blueprints that are set for all the authorities worldwide, not to have an effective mechanism for crisis management, liquidation, resolution. Deposit guarantee schemes, you're right, there is not much harmonization at the international level there. There are some bodies that foster collaboration. But all in all, let's say, it is more, there aren't a lot of differences. I mean, the point is the toolbox, and what are the tools is clear to everybody. So we should just try to implement and learn from the best practices which are out there. And I think in the US, for instance, we have a very good benchmark.
In the middle, lady, in the white sweater.
Hello, thank you for coming here tonight. I'm Christina Vignier and I'm a Bocconi alumni. Continuing on the EDIS subject, I wanted to ask if you perhaps have any thoughts on what circumstances, perhaps macroeconomic or some policy proposal types that could create a new push towards the implementation of the European Deposit Insurance Scheme?
Well, usually, there is this saying that is also based on a famous quote from Jean Monnet, that Europe develops during crisis. So the idea is that you need another crisis to give it another go and complete also EDIS. I mean, I must say I cannot surrender to this logic, and I also am concerned that if you have another crisis, it could be very disruptive also for our arrangements. So I really, tend to trust the wisdom of our policymakers and hope that, the good arguments that have been put forward by all the European authorities that are dealing with this issue, we are very united with the Commission, with the Single Resolution Board, with the EBA, in arguing for further progress in this area. The Parliament has been also pretty supportive, so I think it's really an issue of having the member states moving. I think, and that's a point I want to make, and I made somewhat in my speech tonight. In the early 2000s, when I was at the Committee of European Banking Supervision, I felt a lot of pressure from the industry for step forward into integration of our supervisory and institutional environment. Now I don't feel that the industry is very much pushing for it. So if you don't have the industry pushing, it's something which is politically complex, then it might be difficult to make progress. So I hope that now that banks come back to profitability, robust profitability, they will be more willing to maybe invest to develop their franchise also in other member states, and they will discover a new appetite for a more integrated market environment, and they will also put pressure on policy making to have the completion of the banking union accomplished.
I'll take one more question with the hand up. So this is the last question.
Hi, I'm Hayan Chowdhury. I just started as a supervisor at the Bank of England, actually. But you mentioned briefly the presence of Brexit banks making the most of the European market. I was wondering the other way around, how you've managed the presence of European banks in the UK that's often very significant in the aftermath of Brexit.
To be honest, also so far at least, the benefits of the single market have not been excessively disrupted for European banks. Many of them still operate with branches, for instance, and the Bank of England has provided, a quite long period in which they allowed the banks from continental Europe to continue operating under those arrangements. As I mentioned, the collaboration with the Bank of England is very good. So again, for me, it's an issue of having a good framework for developing the business. Maybe the area which is a bit delicate and also controversial is the issue of clearing, in which the bulk of clearing is done here in the UK, also for euro-denominated products, and there is some push, also from the concerns of having the bulk of your activity being cleared offshore to some extent, from the European side, to have at least European banks developing also onshore in the banking union a clearing capabilities. So that I think is an element maybe still difficult and of friction, because there is a lot also of political, legislative pressure and discussions underway. But for the rest, I think there hasn't been too much relocation. So basically business as usual, I would say.
I'm sure that you'll all agree that Andrea Enria has given us a splendid evening, and can we thank him in the traditional way?
Thank you.